Good morning, and welcome to Market Meridian Journal. I'm your host Eric, and today is March 11th, 2026. We're opening with a market landscape defined by extreme volatility, a collapsing oil risk premium, a softening US dollar, and resilient gold prices. Over the past 24 hours, we've seen oil prices suffer their worst single-day drop since 2022, while gold held firm as a safe haven anchor. The dollar is testing critical support, and the VIX fear gauge remains elevated, signaling persistent investor anxiety. In the next hour, we'll break down the past 24 hours' key moves, unpack the real-time data from your screens, and map out precise levels and catalysts to watch for the next 24 hours. Let's start with the biggest story, the oil crash. Oil's collapse is the defining move of the past day, driven by a sudden erosion of geopolitical risk premium. Former President Trump's comments that the Iran conflict is basically over erased weeks of war-related pricing, while hints of Russian oil sanctions relief added further downward pressure. Even a surprise draw in API crude inventories failed to stem the sell-off, as traders repositioned for a world with less supply disruption risk. As we move into the next 24 hours, oil will remain in focus, with EIA inventory data and Middle East development set to drive volatility. Let's dive deeper into the oil market's past 24 hours and what lies ahead. Let's dive into the most dramatic move of the past 24 hours, crude oil. WTI crude plunged 11.94% yesterday, and as of 14:29 today, it's trading at $83.73, up a modest 0.34% from the session low. Brent crude is at $87.99, still down 3.2% on the day. The trigger for this collapse was twofold. First, Trump's assertion that the Iran conflict is basically over, which wiped out the war premium that had kept oil above $95 for weeks. Second, the White House signaled it may lift Russian oil sanctions, easing global supply concerns and adding further downward pressure. API data released overnight showed a surprise 1.68 million barrel drawdown in U.S. crude inventories, a typically bullish signal, but this was completely overshadowed by the geopolitical news. Traders sold oil indiscriminately, prioritizing the removal of war risk over near-term supply tightness. The commodity index, CRB, fell 2.48% to 348.03, confirming broad-based weakness in energy and industrial commodities. Energy stocks led losses in U.S. equities, with the S&P 500 energy sector down over 3% in the past 24 hours, reflecting the sharp repricing of oil's risk premium. Looking at real-time data, WTI crude has found a near-term floor at $83. A break below this level would open the door to further downside toward $80, a key psychological support zone. Brent crude, meanwhile, is trading at $87.99, with resistance at $90. This level has acted as a hard ceiling for months, as OPEC Plus has signaled it will increase supply if prices rise too high. The market is now repricing oil for a scenario where Middle East supply disruptions are less likely, and the removal of Russian sanctions could add more barrels to the global market. Traders are now watching two key technical levels for WTI, support at $82 and resistance at $85. A break below $82 would confirm a deeper correction, while a move above $85 could signal a short covering rally. For Brent, the range is $85 to $90, with a break below $85 targeting $82 and a break above $90 opening up $93. The market sentiment has shifted sharply from bullish to neutral, with many traders now expecting oil to trade in a range for the foreseeable future, barring a new escalation in Middle East tensions. Looking ahead to the next 24 hours, the key catalyst for oil will be the EIA crude inventories report, due at 22:30 Universal Time Coordinated. Consensus expectations are for a build of 1.38 million barrels, which would confirm that U.S. supply is rising. A larger-than-expected build would push WTI toward $82, while a smaller build or a drawdown could spark a short covering rally to $85. Beyond inventory data, traders will be closely monitoring Middle East developments. Any escalation in Israel-Hamas fighting or new US-Iran tensions would quickly reverse the oil sell-off and reintroduce the risk premium. Geopolitical risk remains the wild card for oil. If the US or Iran takes military action, Brent crude could spike back to $93 in a matter of hours, erasing all of yesterday's losses. Conversely, if tensions continue to de-escalate, oil could fall further toward $80. For short-term traders, the best strategy is to range trade WTI between $82 and $85 with tight stops, avoiding chasing momentum until we see a clear break of these levels. Long-term investors should wait for more clarity on geopolitical risks and OPEC+ policy before making new positions. For short-term traders, range trading WTI between $82 and $85 is the most prudent approach. Buy near $82 with a stop loss below $81, targeting $85. Sell near $85 with a stop loss above $86, targeting $82. For Brent, the range is $85 to $90, with similar stop loss levels. It's critical to tighten stops on any geopolitical news, as oil prices can move sharply in response to conflict or de-escalation. Long-term investors should avoid making new positions in oil until we see a clear trend emerge, as the market remains highly uncertain. Long-term investors should focus on the bigger picture. Oil's long-term fundamentals remain supportive, with demand from emerging markets and underinvestment in new supply set to keep prices elevated over the next few years. However, in the short term, volatility is likely to remain high, so it's best to wait for a more stable entry point. For those looking to hedge against inflation or geopolitical risk, gold remains a better option than oil, as it's less sensitive to short-term supply and demand fluctuations. While oil crashed, gold stood its ground, a clear sign of its role as the ultimate safe haven asset. As of 14/29, spot gold is at $5,217.12, up 0.47% on the day, while New York gold futures are at $5,224.80, down 0.33% as traders lock in profits. Gold's resilience in the face of oil's collapse highlights its unique position as a hedge against both geopolitical risk and currency debasement. Let's shift our focus to precious metals, unpacking the past 24 hours' moves and what lies ahead for gold and silver. Gold's performance over the past 24 hours is a masterclass in safe haven demand. Despite Trump's comments de-escalating Middle East tensions, gold held firm, supported by a weakening US dollar and lingering uncertainty about the global economic outlook. The dollar index, DXY, fell to 98.8 for 1, making dollar-denominated gold cheaper for international buyers, while rate expectations remain dovish, limiting the upside for bond yields and supporting non-yielding assets like gold. Let's dive deeper into the precious metals market. Let's shift to precious metals. Gold stood its ground as the ultimate safe haven asset. As of 14/29, spot gold is at $5,217.12, up 0.47% on the day, while New York gold futures are at $5,224.80, down 0.33% as traders lock in profits. Over the past 24 hours, gold was supported by two key factors. First, dollar weakness, with a DXY falling to 98.8 for 1, making gold cheaper for international buyers. Second, lingering geopolitical uncertainty, as even with Trump's comments, the Middle East remains a tinderbox, keeping safe haven flows into gold intact. Rate expectations also played a role in gold's performance. The CME FedWatch tool shows a 99.4% chance of no rate cut in March, with the first cut fully priced in for June. This limited gold's upside, as higher interest rates typically weigh on non-yielding assets, but it didn't derail the rally, as the market is still pricing in rate cuts later this year. Silver also performed well, with spot silver at $88.797, up 0.56% on the day, tracking gold's momentum but with additional industrial demand support. Looking at real-time data, gold's technical picture remains bullish. Resistance sits at $5,250, the 2025 high. A break above this level would target $5,300. Support is at $5,180, a level that has held multiple times in the past few weeks. The slight divergence between spot gold and futures, spot is up, futures are down, reflects short-term profit-taking by traders, not a reversal of the bullish trend. Silver's technicals are also bullish, with resistance at $90 and support at $87. Gold's relative strength compared to oil and equities highlights its role as a portfolio diversifier. When risk assets like oil and stocks sell off, gold tends to hold its value or even rise, making it an effective hedge against market volatility. Silver, meanwhile, has both safe haven and industrial demand, making it more sensitive to economic growth expectations. The gold-silver ratio is currently around 58.7, which is below its long-term average, suggesting that silver is relatively undervalued compared to gold. Looking ahead to the next 24 hours, the key catalyst for gold will be the US CPI data, due at 2030 Universal Time Coordinated. Consensus expectations are for a 0.2% month-over-month increase and a 2.4% year-over-year increase. A hotter-than-expected print will boost the dollar and pressure gold toward $5,180 as it reinforces the Fed's higher-for-longer rate stance. A cooler-than-expected print, on the other hand, will send gold to test $5,250 as it raises hopes for earlier rate cuts. Geopolitical developments will also continue to influence gold prices. If Middle East tensions escalate, gold will ignore rate fears and surge past $5,250 as safe haven flows intensify. Conversely, if tensions de-escalate further, gold could give back some of its recent gains, but the weak dollar should provide a floor. For silver, the outlook is similar to gold, but it will also be sensitive to industrial demand data, which could be impacted by slower global growth. For short-term traders, the best strategy is to buy dips in gold to $5,180, with a stop loss below $5,160, targeting $5,250. For silver, buy dips to $87, with a stop loss below $86, targeting $90. Long-term investors should maintain a core allocation to gold, 5 to 10% of their portfolio, as a hedge against inflation and geopolitical risk. Silver can be used as a more speculative play on gold's rally and industrial demand growth. Long-term investors should avoid timing the market and instead focus on dollar-cost averaging into gold and silver positions. Gold's long-term fundamentals remain strong, with central bank buying, geopolitical uncertainty, and inflation concerns all supporting higher prices over the next few years. Silver, meanwhile, has additional upside from green energy demand, as it's a key component in solar panels and electric vehicles. Let's now shift our focus to the US dollar and currency markets, which are the backbone of global financial markets. The US dollar is the backbone of global markets, and right now, it's on the ropes. As of 14/29, the DXY is at 98.8 for 1, down 0.1% on the day, testing a critical support level. The dollar's weakness is driven by a combination of factors: Trump's rhetoric on US trade and currency policy, global policy divergence, and safe haven flows into gold and the yen. Let's dive into the currency markets, unpacking the past 24 hours' moves and what lies ahead for the dollar and major currency pairs. The dollar's decline over the past 24 hours is part of a broader trend that has seen the DXY fall from a high of 103.0 in January 2026 to its current level near 98.8. This decline is driven by the market's expectation that the Fed will cut rates later this year, while other central banks like the ECB and BOJ remain hawkish. The dollar's yield advantage is eroding, making it less attractive to international investors. Let's dive deeper into the currency markets past 24 hours and what lies ahead. Let's shift to the US dollar and currencies. The DXY is at 98.8 for 1, down 0.1% on the day, testing critical support. Over the past 24 hours, the dollar was weakened by two key factors. First, Trump's comments on US trade and currency policy, which raised concerns about potential protectionist measures and currency devaluation. Second, global policy divergence, with the ECB and BOJ remaining hawkish, while the Fed is stuck in a higher-for-longer stance, eroding the dollar's yield advantage. Safe haven flows also worked against the dollar, as investors favored gold and the yen over the greenback, despite geopolitical risks. The yen has strengthened significantly against the dollar in recent weeks, with US dollar to Japanese yen hovering near 100.2, in a critical intervention zone for the Bank of Japan, BOJ. The euro also strengthened against the dollar, with euro to US dollar at 1.088, supported by eurozone economic resilience and the ECB's hawkish stance. Looking at real-time data, the DXY is testing a critical support level at 98.5. A break below this level would trigger a technical breakdown, opening the door to further downside toward 97.8. Resistance is at 99.2, a level that has acted as a ceiling for the past few weeks. For US dollar to Japanese yen, the pair is hovering near 100.2, with the 99.5 to 100.5 range marking a critical intervention zone for the BOJ. A break below 99.5 could trigger official yen buying, causing a sharp spike in the pair. Euro to US dollar is at 1.088, with eyes on the 1.09 resistance level. A break above this level would target 1.10, supported by Eurozone economic resilience and the ECB's hawkish stance. Pound sterling to US dollar is also strong, at 1.27, supported by UK economic growth and the Bank of England's hawkish stance. The Australian and New Zealand dollars are also performing well, supported by commodity prices and risk appetite. Looking ahead to the next 24 hours, the key catalyst for the dollar will be the US CPI data, due at 2030 Universal Time Coordinated. A hotter-than-expected print will push the DXY back to 99.2, as it reinforces the Fed's higher-for-longer rate stance. A cooler-than-expected print, on the other hand, will break the 98.5 support level, sending the DXY toward 97.8. Beyond CPI data, traders will be closely monitoring the BOJ's actions. Any move below 99.5 in US dollar to Japanese yen will likely prompt intervention, causing a sharp spike in the pair. For euro to US dollar, the outlook is bullish, with a target of 1.095 on dollar weakness. Support is at 1.082. For pound sterling to US dollar, the outlook is also bullish, with a target of 1.28. For the Australian and New Zealand dollars, the outlook is positive, supported by commodity prices and risk appetite. The Swiss franc is also likely to strengthen against the dollar, as safe haven flows persist. For short-term traders, the best strategy is to short the DXY on a break below 98.5, with a stop loss above 99.0, targeting 97.8. Alternatively, go long euro to US dollar, with a stop loss below 1.082, targeting 1.095. For US dollar to Japanese yen, it's best to avoid trading the intervention zone unless you're prepared for extreme volatility, as the BOJ is likely to act aggressively to defend the yen. Long-term investors should consider diversifying their currency exposure away from the dollar, as the long-term trend is likely to be lower. Long-term investors should consider allocating a portion of their portfolio to non-dollar currencies, such as the euro, yen, or Swiss franc, to hedge against dollar weakness. Emerging market currencies are also likely to benefit from dollar weakness, as it makes dollar-denominated debt cheaper and boosts commodity prices. Let's now shift our focus to US equities and market sentiment, which have been mixed over the past 24 hours. US equities were mixed over the past 24 hours, with tech stocks under pressure and defensive sectors outperforming. The VIX fear gauge is at 24.12, up 1.81%, signaling persistent investor anxiety. The Nasdaq fell 1.56% yesterday, as rate hike fears hit high-growth tech stocks, while utilities and consumer staples rose, as investors rotated into safer, higher-yielding assets. Let's dive into the equity market, unpacking the past 24 hours' moves and what lies ahead. Performance of US equities reflects the market's uncertainty about the economic outlook. On one hand, a strong labor market and consumer spending are supporting economic growth. On the other hand, sticky inflation and rate hike fears are weighing on high-growth stocks. The VIX fear gauge remains elevated above 24, indicating that investors are nervous about the future and volatility is likely to remain high in the coming days. Let's dive deeper into the equity market's past 24 hours and what lies ahead. Let's shift to US equities. The market was mixed over the past 24 hours, with tech under pressure and defensives outperforming. The Dow Jones Industrial Average fell 0.07% to 47,706.51, the S&P 500 fell 0.21% to 6,781.48, and the Nasdaq Composite rose 0.01% to 22,697.10. Tech stocks were mixed, Nvidia and Meta rose, while Microsoft and Apple fell. Energy stocks led losses, down over 3%, reflecting the sharp drop in oil prices. Utilities and consumer staples rose, as investors rotated into safer, higher-yielding assets. The key driver of the equity market's performance was rate expectations. The CME FedWatch tool shows a 99.4% chance of no rate cut in March, with the first cut fully priced in for June. This weighed on high-growth tech stocks, which are sensitive to interest rates, as higher rates reduce the present value of future earnings. Retail sales data released yesterday also missed expectations, rising 0.3% in February, below the consensus forecast of 0.5%, reinforcing concerns about a consumer slowdown. Looking at real-time data, the S&P 500 has support at 6,700, a break below this level would target 6,600. Resistance is at 6,820. The Nasdaq has resistance at 22,800 and support at 22,400. The VIX fear gauge is at 24.12, up 1.81%, signaling persistent investor anxiety. A drop below 22 would signal a return of risk appetite, while a move above 26 would indicate rising fear and volatility. Sector performance reflects the market's defensive rotation. Utilities and consumer staples are the best performers, up 0.5% and 0.3% respectively, while energy and technology are the worst performers, down 3.2% and 0.8% respectively. This rotation is driven by investors seeking safety and yield in a volatile market environment. Large-cap stocks are outperforming small-cap stocks, as investors favor larger, more stable companies. Looking ahead to the next 24 hours, the key catalyst for equities will be the US CPI data, due at 20:30 Universal Time Coordinated. A hotter-than-expected print will weigh on tech stocks and push the S&P 500 towards 6,700 as it reinforces the Fed's higher-for-longer rate stance. A cooler-than-expected print, on the other hand, will spark a relief rally, sending the S&P 500 towards 6,820. Beyond CPI data, traders will be closely monitoring Fed speak. Williams and Bostic are scheduled to speak, and hawkish comments will further pressure growth stocks. Geopolitical developments will also continue to influence equities. If Middle East tensions escalate, equities will sell off, as investors rotate into safe haven assets like gold and the yen. Conversely, if tensions de-escalate, equities will rally, as risk appetite returns. Tech earnings next week will also be a key catalyst, with Nvidia's GTC conference set to drive volatility in the semiconductor sector. For short-term traders, the best strategy is to avoid overvalued tech stocks and focus on value and defensive sectors, such as utilities, consumer staples, and energy. Buy the S&P 500 near 6,700 with a stop loss below 6,650, targeting 6,820. Sell the Nasdaq near 22,800 with a stop loss above 22,900, targeting 22,400. Long-term investors should use dips to accumulate high-quality stocks, as the long-term fundamentals of the U.S. economy remain strong. Long-term investors should focus on companies with strong balance sheets, consistent earnings growth, and a competitive advantage. Avoid companies with high debt levels or exposure to cyclical sectors, as they are more sensitive to economic downturns. Consider allocating a portion of your portfolio to defensive sectors, such as utilities and consumer staples, to hedge against market volatility. Let's now shift our focus to emerging markets and commodities, which are feeling the effects of dollar weakness and oil's collapse. Emerging markets, EM, and commodities are feeling the effects of dollar weakness and oil's collapse. The MSCI EM index rose 0.5% over the past 24 hours, led by India, Brazil, and Mexico, as dollar weakness made EM assets more attractive. Chinese A shares fell 1.8%, due to US tariff threats and property sector risks. The commodity index, CRB, fell 2.8%, led by oil, but precious metals and copper held firm. Let's dive into the EM and commodity markets, unpacking the past 24 hours' moves and what lies ahead. Dollar weakness is a tailwind for EM assets, as it makes dollar-denominated debt cheaper and boosts commodity prices, which are a key export for many EM countries. India's Nifty 50 is at a record high, supported by strong domestic growth and foreign inflows. Mexico's peso is at a 5-year high, benefiting from nearshoring and strong economic growth. Let's dive deeper into the EM and commodity markets. Let's shift to emerging markets and commodities. EM equities rose 0.5%, led by India, Brazil, and Mexico, while Chinese A shares fell 1.8%. The MSCI EM index rose 0.5% over the past 24 hours, supported by dollar weakness and strong domestic growth in key EM countries. India's Nifty 50 is at a record high, driven by strong corporate earnings and foreign inflows. Brazil's Bovespa rose 0.8%, supported by higher commodity prices. Mexico's IPC rose 0.6%, benefiting from nearshoring and strong economic growth. Chinese A shares fell 1.8%, due to US tariff threats and ongoing concerns about the property sector. The yuan also weakened against the dollar, as investors worried about the impact of tariffs on China's economy. Commodities were mixed. The CRB index fell 2.48%, led by oil, but precious metals and copper held firm. Copper rose 1% to $4.20 per pound, supported by Chinese construction demand. Agricultural commodities like corn and wheat were steady, as supply concerns from the Black Sea region persist. Looking at real-time data, the top EM performers are India, Brazil, and Mexico, while the worst performers are China and Turkey. India's Nifty 50 is at a record high, with a year-to-date gain of 12%. Brazil's Bovespa is up 8% year-to-date, supported by higher commodity prices. Mexico's IPC is up 7% year-to-date, benefiting from nearshoring. Chinese A shares are down 5% year-to-date, due to US tariff threats and property sector risks. Commodities, copper is at $4.20 per pound, up 1% on the day, supported by Chinese construction demand. Iron ore is at $120 per ton, supported by Chinese stimulus measures. Agricultural commodities like corn and wheat are steady, as supply concerns from the Black Sea region persist. Precious metals are the best performing commodity sector, with gold and silver holding firm despite oil's collapse. Looking ahead to the next 24 hours, EM equities will continue to outperform developed markets if the dollar weakens further. Focus on India, Indonesia, and Mexico, which have strong growth prospects and low debt levels. Chinese A shares will remain range-bound, with stimulus hopes and tariff threats creating volatility. Avoid overexposure to property and financials in China. Commodities, copper and agricultural commodities will hold firm, while oil remains under pressure. Precious metals will be the best hedge against uncertainty. For EM currencies, the Mexican peso and South Korean won are likely to strengthen against the dollar, supported by dollar weakness and strong economic growth. The Turkish lira and Argentine peso will remain under pressure, due to high inflation and political instability. For commodities, the key catalyst will be the EIA crude inventories report, which will impact oil prices, and the US CPI data, which will impact precious metals and copper. For short-term traders, the best strategy is to go long EM equities, focusing on India, Brazil, and Mexico. Buy the MSCI EM index with a stop loss below 1,000, targeting 1,050. For commodities, buy copper near $4.15 with a stop loss below $4.10, targeting $4.25. Sell oil near $85 with a stop loss above $86, targeting $82. Long-term investors should allocate 15 to 20% of their portfolio to EM equities and currencies to benefit from dollar weakness and strong growth in EM countries. Long-term investors should also consider allocating a portion of their portfolio to commodities, such as copper and agricultural commodities, to hedge against inflation and geopolitical risk. Precious metals should remain a core holding, as they are the best hedge against market volatility and currency debasement. Let's now shift to our final segment, where we'll distill the past 24 hours' key moves and provide a forecast for the next 24 hours, along with strategic takeaways for traders and investors. We've covered every corner of today's market, from the oil crash to gold's resilience, the dollar's weakness to equities' defensive rotation. Now, Let's distill the final analysis and forward-looking forecasts for the next 24 hours, along with strategic takeaways for traders and investors. The past 24 hours have been defined by a collapse in oil's geopolitical risk premium, a softening US dollar, and resilient gold prices. The VIX fear gauge remains elevated, signaling persistent investor anxiety. Looking ahead, the next 24 hours will be driven by key catalysts: the US CPI data, EIA crude inventories, Fed speak, and Middle East developments. These catalysts will determine the direction of the dollar, gold, oil, and equities. Let's now dive into the final analysis and forecast, providing actionable insights for traders and investors. Let's distill the final analysis of the past 24 hours. Oil crashed 11.94%, erasing the geopolitical risk premium, with WTI at $83.73 and Brent at $87.99. Gold held firm at $5,217.12, supported by dollar weakness and safe haven flows. The dollar index, DXY, fell to 98.8 for 1, testing critical support at 98.5. US equities were mixed, with tech under pressure and defensives outperforming. The S&P 500 fell 0.21%, the Nasdaq rose 0.01%, and the VIX fear gauge is at 24.12. EM equities rose 0.5%, led by India, Brazil, and Mexico, while Chinese A shares fell 1.8%. Looking ahead to the next 24 hours, here are the key levels to watch. For the DXY, support is at 98.5, resistance at 99.2. For gold, XAU, support is at $5,180, resistance at $5,250. For WTI crude, support is at $82, resistance at $85. For the S&P 500, support is at 6,700, resistance at 6,820. For US dollar to Japanese yen, the intervention zone is 99.5 to 100.5. The key catalysts are US CPI data, EIA crude inventories, Fed speak, and Middle East developments. For short-term traders, short the DXY on a break below 98.5, targeting 97.8. Buy gold dips to $5,180, targeting $5,250. Range trade WTI between $82 and $85 with tight stops. Avoid trading US dollar to Japanese yen in the intervention zone. Focus on value and defensive sectors in equities, avoiding overvalued tech stocks. Tighten stops on any geopolitical news, as market volatility is likely to remain high. For long-term investors, rotate to value and defensive sectors in equities, such as utilities, consumer staples, and energy. Maintain a 5 to 10% core allocation to gold as a hedge against inflation and geopolitical risk. Allocate 15 to 20% of your portfolio to high-growth EM markets, such as India, Indonesia, and Mexico, to benefit from dollar weakness. Consider allocating a portion of your portfolio to commodities, such as copper and agricultural commodities, to hedge against inflation. Avoid timing the market and focus on dollar cost averaging into high-quality positions. Disclaimer: this broadcast and all analysis are for informational and educational purposes only and do not constitute personalized investment advice, a recommendation to buy, sell any security, commodity, currency, or financial instrument, nor an offer, solicitation of any transaction. All views are based on publicly available data as of March 11, 2026, 14:29, and are subject to change without notice. Market Meridian Journal, its analysts, and affiliates make no warranties as to accuracy, completeness, or timeliness of content. Financial markets involve substantial risk, you may lose principal. Past performance is not indicative of future results. Consult a qualified financial advisor before making investment decisions. Market Meridian Journal and its personnel may hold positions in assets discussed. By accessing this content, you acknowledge understanding and acceptance of these terms. The information provided is not intended to be a substitute for professional financial advice, and you should not rely on it to make any investment decisions. Always do your own research and due diligence before investing in any financial instrument. Thank you for joining us for today's Market Meridian Journal. We've covered the past 24 hours key moves, unpacked the real-time data, and provided a forecast for the next 24 hours, along with strategic takeaways for traders and investors. Remember to stay informed, stay disciplined, and manage your risk carefully in this volatile market environment. We'll be back tomorrow morning with the latest market updates and analysis. Until then, have a great day and happy trading. Goodbye, and thank you for watching Market Meridian Journal. We'll see you tomorrow at the same time for more in-depth financial analysis and forecasts. Stay safe, stay informed, and we'll talk to you soon.